So we started Chapter 9 a little bit before the quiz. And so I'm just going to briefly review what we already covered before we get into the new material. So this chapter was really about identifying cash flows and what cash flows go into our calculation of free cash flows. Some of the things that we covered were using free cash flows and not accounting profits. That was one of the main things. And then to use incremental cash flows. So cash flows that are purely a result of this project and would not exist otherwise. And so examples of that were like ignoring sunk costs, including indirect costs, and also opportunity costs where you have different alternatives. I'm just going to skip over some of these slides here. Let's see. We went through, we had a little quiz, right? And then we talked about inflation. The main thing is if you either include it or exclude it, and you have to be consistent in terms of using cash flows and interest rates that both either include or exclude inflation. For us, normally we just use nominal interest rates and nominal cash flows. And as long as you do that, you're fine. We separate the investment and financing decisions so that don't worry about expenses related to the loans. That's all taken care of in the discount rate. And then this was our equation for free cash flows. And we touched on this before earlier in the year. It's basically earnings before interest and tax. Then we subtract out taxes, and then we add back depreciation, right? Because we need that in EBIT to calculate taxes, but it's a non-cash expense, so then we add it back in. And then we subtract the increase in working capital and any capital expenditures. So the bottom line is that free cash flow, we use that equation every single year and calculate that every single year of our forecast that goes into the, in analyzing the investment project. So let's take a look at an example now. And I just put up a spreadsheet there, and I uploaded it to Blackboard as well. And here's some of the assumptions for this analysis. And I wrote in a lot of the information already. So depreciation, looks like I have a spelling mistake there in depreciation. Depreciation is straight line for 5 years. There's a salvage value of $1,300 in year 6, and that's after taxes are paid. Tax rate's 35%, and working capital is taken to 0 in year 6. And then everything else here is part of our assumptions. So the deal is we need to use this information to calculate free cash flows. Now I'm going to switch my screen over to the spreadsheet, Chapter 9 spreadsheet. All right, so you should be able to see it now. All right, there we go. So these are the same numbers. And let's not forget, I'm going to write the equation up here. So this is the equation. The equation for free cash flow is equal to EBIT minus taxes plus depreciation. See if I can spell it right this time. Minus increase in working capital and minus capital investment. That's basically the equation we're trying to build. And if you look at this, we already have EBIT, we already have taxes, but now let's see, we already have depreciation. We need to calculate the increase in working capital. And so I'm going to do that right here. And I think the easiest way to do it, let's start in year 1. And if you recall, that is equal to the current year level of working capital subtracted by the previous year's working capital. So for this year 1, it's going to be this 4075 minus this 1500. And so let's just do it in your head, kind of think, is that right? 4,075 minus 1,500. Yeah, that's about 2,575. That's right. Now here's the thing in Excel. To be kind of efficient with our time, we're going to grab this formula in the lower right-hand corner, press down, and then drag the formula across. And you'll see Excel kind of takes care of populating the formula, and it even changes the cell references over 1 as you copy it to the right. So let's look at year 2 here. Year 2, it says it's equal to D14 minus C14. Yeah, that looks right. So that copied over correctly. And then let's just make sure the math is right. Here in year 6, it's H14 minus G14. So 0 minus 3039. And that's a negative 3039. So yeah, that all looks right. So now we have the increase in working capital calculated. And we have capital investment. That's all done. And that's a negative cash flow. And then salvage value is going to be a positive cash flow at the end. So we'll have to make sure we remember that. The other thing here is increase in working capital in year 0. I didn't copy that formula over there because from a formula in Excel cells perspective, we can't really use the cell before it, right? So it would look like this. It would be the current year, 1,500, minus the previous year. And when we're talking year 0, the previous year is just going to be 0, kind of year -1, if you will. Okay, so the whole working capital in year 0 is all an increase, basically. That's what it's saying. Any question about calculating working capital right here?
No.
No? All right, let's go ahead and calculate free cash flow. And the way I'd like to do this is we're going to create one formula in year 0, and then we're just going to drag and drop that formula all the way across through year 6. Okay, so that means I want to take into account in my formula every single cash flow I have from every year. And the nice thing about this is it'll be really easy to drag and copy the formula across from year 0 to year 6. So I only have to do it once. So here's where I'm going to start. I'm going to start with the free cash flow formula down here. So for I put everything in from a year 0 perspective, and then when we copy the formula to the right, Excel will automatically change the reference from the year 0 column to the year 1 column and then to the year 2 column. So we first do EBIT, and then we subtract taxes, and then we add back depreciation. And I know there's nothing in those cells right now, it's just 0, so it won't give us the wrong answer. But again, by highlighting it here in year 0, it allows me to copy it over to the other years, and then I don't have to touch the formula. It's like it's like one formula to rule them all, kind of like Lord of the Rings. And then after adding back depreciation, we're going to subtract the increase in working capital, which is right here. And then we're going to subtract the capital investment, which is right here. Now, later on in year 6, We are going to have some salvage value, so I'm just going to plug that in right here. And that's a plus because salvage value will give us a positive cash flow. Now I just hit enter. And let's just double check our formula. Does this look right? So we had a $10,000 capital investment, which is a negative cash flow. And then the increase in working capital also has to be subtracted. So that's a total of minus 1150, 11,500. That looks right, yeah. All right, now I'm going to copy this all the way over, and then we'll double check our formula in a couple of years just to make sure it looks right, okay? So I'm going to double check. You should always do this with your formulas. So let's see. So this year it's going to be EBIT, which is 3,000. And then we subtract taxes, which is right here, which is 1050. Then we add back depreciation, which is 2,000. And then we subtract the increase in working capital. That's 2,575 right here. And I think that's it. Let's see what we get. Okay, so that was the same number. We just did it manually. So the math seems to look good. So those are our cash flows. And that's kind of the strategy on these investment projects when you're trying to calculate MPV or IRR is first get your assumptions down, all the different expenses and revenues. Then you calculate your increase in working capital, and then you go ahead and calculate the free cash flows. Any questions on this spreadsheet calculating free cash flows and the increase in working capital? Why is there an asterisk on the free cash flows? There's an asterisk because I just wanted to show everybody what the formula was. So it should look like that. How's that? And how did you copy the formula over again? Yeah, Alyssa left a comment. So like, let's say here, I'm going to delete all this, okay? And I put my formula in here, and you can see it right there, right? And now I'm going to go back out. Now, when you just select it once, like Alyssa said, just you hover your mouse over the lower right-hand corner, then you click with your mouse, and then you drag. And then when you get to as far as you want to copy the formula, then you let go of your mouse. And then it automatically populates. So that's pretty slick. So you should definitely check out and practice that and try to do it. All right, so this is what we just did. We went through the free cash flow calculation. And this slide kind of walks you through it as well. Here we calculated the increase in working capital, and you see we put in this line here, and these little bubbles and arrows kind of show you how every single number was calculated. Okay. And then we go ahead and we calculate the free cash flows. And here again, it shows you how each of these numbers were calculated to get free cash flows. Hey, the next step is to calculate MPV. So why don't we go ahead and do that, assuming the discount rate R is equal to 12%. All right, let me hear from you all. What should I do with the free cash flow in year 0? Does that go inside the MPV formula?
No.
Correct. Yeah, so we're just and I'm gonna link to it right here, right? And now we add to it using the MPV formula and our discount rate, 0.12. Now we just click on each year. Year 1, year 2, year 3, and so on, all the way till the end, right? So that right there should give us the NPV for this project. Hopefully it's positive. Let's see what happens. And it is positive. Excellent. And that was the formula right there. And it's also on the PowerPoint slide we just came from. All right, so that is the end of Chapter 9.